afternoon. I'm Pamela Hastings, Relationship Manager here at Barometer Capital, and welcome to another Barometer Readings webcast. On today's webcast, we have, as always, joining us David Burrows, our Chief Investment Officer, and we've invited two key portfolio managers, Jim Shatakis and James Callahan, to join us and talk to us about what they're seeing on the trading desk. As always, we will provide you with a brief macro overview. And of course, at the tail end of the conversation, we would be pleased to answer your questions. So don't be shy. You can send us those questions via the Q&A and the chat on Zoom. And with that, on this second last Tuesday of April, I turn the conversation over to the one and only David Burrows. Good afternoon, David.
Hi, Pamela. Thanks very much for hosting today, and thanks, Jim. And James for jumping on. Welcome everybody. We've been doing this now every week since the beginning of COVID, and I suppose we're probably going to do it forever, every Tuesday. It's turned out to be a pretty good tool to help us kind of share some of our thoughts on what's going on market-wise, how it's impacting what we're doing in the portfolios. Partly it's transparency to make sure that clients and friends of the firm can see that we are following our process. And that we do what we say we're going to do. A lot of the process that we built along the way is to help us from making big mistakes, where people make the biggest impacts on their portfolios. Generally, are letting little mistakes turn into big ones. And so a lot of the process that we've built along the way has been aimed at helping to make sure that we don't do that, because really no one position is so important that we're willing to take it down with the ship. So just from that standpoint, we always start with a high level view. I'm sitting here, the building we're in, BCE Place here in Toronto, is creaking. I guess it's awfully windy outside, so hopefully you can't hear that too much, or hopefully we don't go over. As we've been saying for some time now, we think we're in a structural bull market in stocks. US kicked it off in 2013, and we've been sort of taking 3 steps forward versus 1 step back from time to time. Since then, it's a much different environment than being in a structural bear market. We have big, deep declines that really you just can't live through. And we always think that it's important to understand what the backdrop is, what we're working against. In a structural bull market, you can be a little bit more tolerant of pullbacks, but you still have to manage them, because buried in those long run-ups in prices, some pretty good declines. When we look at the last 2 structural bull markets, we can see that the corrections come in time or in price. This is 1987. That seemed pretty bad at the time. 1990, 91. And frankly, we went through 25 months from the end of 2021 through January of 2024, where we churned our way through a cyclical bear market. As is often the case in a secular bull market, we were lower bound by the rising 200-week moving average, which we touched in October of 22, and we're now 1, 2, 3 months out of it. And you can see this month we pulled back a little bit. Now, a little bit of volatility this week. Friday wasn't great, Thursday wasn't great, but interestingly enough, I was just noticing last week when we did this talk, S&P was down 3.99% on the month. As we sit today, we're down 3.45, so actually a little bit better than where we were on Tuesday of last week, despite the fact that things have moved around. And we talked about the fact that we tend to get, 3 or 4 or 5% corrections in the course of a year. This would be the first one. If we closed out the month now, we're down 3.4%. But I think at the worst point, S&P was down a little bit, almost bang on 5%, and we'll see where we go from here. When we look at the chart, you can see that we had a few days down. We broke the 50-day moving average, which is not insignificant. We do watch that, but we've had a couple of days up a little bit yesterday and a little more today. We'll see what happens. I like to watch some of these oscillators that look at measures of overbought and oversold. This is the McClellan oscillator. It was interesting to see that the pullback that we saw recently actually is as severe on the chart as it was in the pullback at the end of August, and more severe than what we saw in October, interestingly enough. But we got sold out on a very short-term basis by really any measure. A couple of other interesting observations as we went through the last 4 days. This is prior to today. We were seeing fewer stocks at a 1 month low. We were seeing in the Russell 2000, same picture. In the NYSE, same picture. So new lows actually have been contracting. So what happened? A lot of the big companies, the really big index players, had a rougher end to the week. Notably, some of the big tech stocks down pretty hard, and they've bounced yesterday and today. Nasdaq today up about 1.6%. So we'll see whether this was shakeout or not. On Friday, more than 300 companies in the S&P 500 were green, but the index was down 0.9. I mean, to tell you how unusual that is, going back to 1998, happened one other time, October 2020, which was marked the low for the year. Saw 313 stocks up, but it fell 1%. So, we always like to understand what's happening underneath the surface, understand what's driving a decline, see how it's impacting our portfolios. I'll remind you, we put this up a couple of weeks ago, and this is just, to keep in the back of your head. When the market was higher, November, December, January, February, and March, 5 months in a row, happened only a few times since 1950. April had a tendency to be positive, but there was a couple of small negatives, down 1.4, down 2.5. We'll see how the week finishes, but on average was up 1.8. Q2 in general higher, about 2.9%. So a lot of folks might think, well, market's up 5 months in a row, we're due for a big pullback. Really doesn't look that way, and especially when you look out toward the end of the year, market was up 100% of the time, an average of 11.9%. And again, we don't make decisions based on this stuff, but we like to understand the range of possibilities, and understand, kind of what's happened in the past. Which they say, market doesn't repeat, but sometimes rhymes a lot. Now, outside of the U.S., international markets have been pretty strong. Nikkei actually has had a dynamite 52 weeks. As of a week ago, it was up a little over 47%. Over the last 52 weeks. You can see this month we're pulling back. Now, keep in mind, this chart goes back to 1991. So this was a giant base that the Nikkei moved out of. And you may have heard Warren Buffett's been a buyer of Japanese stocks, something just to keep in the back of your mind. Now, pulled back over the course of the month. What might have been driving that? Well, we had a lot of volatility in currencies over the last month. This was from Diana on our trading desk, taking a look at currency volatility. And, markets don't love rates volatility, and they don't love currency volatility, especially when it's the US dollar strengthening rapidly. And we did, over the last month, see a pretty good run up in the US dollar. That sometimes takes away from risk. It shows there's a lack of risk appetite. Sometimes it takes risk appetite away. So I thought it was interesting that when we look at the DXY, the US dollar index, on the bottom here is relative strength. When you've got these peaks in relative strength up at the upper end of the band, it tended to mean US dollar was running out of gas, which it did, of course, back in February. And it looks as though it may be happening here this last 5 days, down pretty sharply today, but maybe part of the reason why risk assets were certainly stronger. But we saw a dollar come off a little, and look, India right back to highs. Euro Stoxx 50. We highlighted that this has come out of a range. It was in from 2007 through 2024. This is the last 5 months. Pulled back sharply last week, and is actually back toward the top end of the range. And the TSX, which acts a lot more like international markets because of its heavy weight in financials and industrials and materials and energy, again, pretty close, right back to the top end of the range. So global markets appear to be pretty resilient. On fixed income, we have, think we saw a generational low in 2020, and the yield on a 10-year treasury, similar to what we saw in the late 1940s. Our view has been that the picture is quite different. 1981 through 2020, a series of lower highs in yield. That was a disinflationary world. We probably got to a generational low here in 2020. And since then, we've been seeing rising lows and rising highs. So this is a very different environment than we've been in since 1981. And that has an influence on what may work from an investment perspective, because there are certain things that are helped in a disinflationary world. For instance, borrowers, that might help things like real estate go up in price when people can afford a higher mortgage price. And on the other hand, in a reflationary world where rates are going higher, it may be better for a lender, financial services companies, or companies that can set price tomorrow if their costs go up today. And that certainly has been the case over the last number of months. So our comment has been that bonds have been in a bear market. This is the TLT, which is the long end of the US bond market. This is the ETF that holds 10 and 20-year bonds since it started selling off in 2020, even to today, down a little over 50%. Of course, people have had a coupon on that, but not a very big one, and a series of lower lows and lower highs. So we probably think from a big picture perspective, we're still in a bear market in bonds until something changes. We're below all of the moving averages, and all the moving averages are headed lower. Why is this important? From a portfolio construction standpoint, a lot of our investing lives, we've been through a period where stocks and bonds were inversely correlated. So when stocks went down, bonds went up, and they provided a pretty good hedge. This is not always the case. Since 2020, they've been positively correlated, and it means that they haven't been a very good hedge. And for a lot of time, especially during rising rates, period late 1940s through the 1980s, stocks and bonds often move together. And so this is an important thing to recognize. It's a shift in the market. It's a shift in what's working. It means that maybe 60-40 portfolio is less relevant today than it was historically, and maybe we want to construct things a little bit more differently. So from a big picture perspective, we prefer stocks over bonds. We think that there's a tailwind here. And when we compare dividend growth as a strategy to bond investing for an income investor, we've seen relative outperformance of the dividend growth ETF RDVY. This was even through the bear market of 2022. They performed roughly the same, and stocks have been outperforming since then. So from a macro perspective, again, we like equities. We like equities not just in the US, we like equities globally. They're performing well for the first time in many years. They are different than US stocks, and they have a place in a portfolio. Commodities. After a very long, protracted bear market, commodity prices is a broad-based commodity ETF. We've seen them rising. We had a first leg higher 2020 into 22. We went through a period where the Fed and every other central bank was tightening, and they have started to reignite and move up and out of that consolidation. So we think maybe we're in the second wave of a longer term bull market in commodities. We look at commodities versus bonds. Well, they're outperforming. And interesting to look at commodities relative to the equally weighted S&P 500. There's some indication maybe they're accelerating here as they did in the early part of 2022. So we'll see. Something to watch. When we look at the underlying parts, copper is something that we think is pretty important. They used to call it Dr. Copper because it tended to sniff out a reacceleration in the economy. And you can see after a long period of time underperforming and going through a tightening cycle, copper over the last few months has started to wake up. So something to watch. Now, we're probably not the only ones watching it. When you look at Chinese inventories and stock levels, you can see that going back, over a long period of time, you can see that the average range of inventories, the mean and the median, has been in this range over the course of the year, each year. And you can see that they've been building inventory. So obviously they're stimulating in China. They're trying to get things going. We'll see whether they have impact, but certainly they've been buyers. On crude, same thing. Crude has been lifting over the last 4 months after coming back and touching the long-term moving averages. That looks pretty constructive. Aluminum certainly is looking a little bit better. Agricultural commodities after a long bear market are performing a little better. Uranium is behaving a little bit better. Basic materials in general and energy certainly are acting better on a relative basis. And there's gold. This is the last long bear market in gold, 1996 through 2003, a very significant run up in price leading into 2010. Another long bear market. We'll see what this one turns into. So these are things that we keep in mind. They're things that help guide us as to what we're focusing in. Lots of central bank buying in the golds. And on the other hand, after a long period of weakness, retail investors, individuals, and fund managers, frankly, have been hesitant to add to their gold holdings, despite the fact that prices are moving higher. That's probably a bullish thing. It means if things continue to be firm, likely there's some others that will come along with the central banks. Just last sort of major asset that we're looking at, and not that we're giant Bitcoin bulls, but we do think it's something to keep an eye on. We do have some exposure in our macro fund. This is back to 2014. There's been a series of bear markets that Bitcoin has been through, and when it's come out, it's tended to have pretty good run up. We'll see what happens, but we're sort of on the cusp there. Interesting that this is happening around the time of the halving. So these are things we've had in mind. Since the middle of March last year, when markets started to broaden out, the equally weighted S&P's up about 18%, TSX up about 17%, the aggregate bond index up about 0.3%. Our income mandate over the period has had a really good run. It's up 22.7% ahead of the major indices. The equity strategy up about 27.5%, our macro strategy up about 26%. And year to date, again, equally weighted S&P up 2.5%, TSX up 5%, aggregate bond index down 3%, income strategy up 9%, equity strategy up 8.7%, macro up 8%. And just from a perspective of a global investment, MSCI All World Index ex-US up about 7%. This is over the last year. And global fund up 13%. I've got the wrong date range here. I apologize. I should have put up year to date because we did convert this fund to a global strategy as of the end of the year. But it's up about 7% against the MSCI All World up about 2%. Okay, that's a mouthful. That's the big picture. Now, we don't have to be everywhere. We use these tools and observations to decide where to focus our portfolios. We often look very unlike an index. We don't have to own everything. Our areas of focus are in trying to own things that have a structural tailwind. So we think equities have a structural tailwind. Certain parts of the equity markets have structural tailwind, where we're seeing earnings growth plus multiple revision, right? Multiple expansion. We always watch for change. Sectors that have been out of favor that start to act a little bit better. We want to take a look at those groups to see what is there in that group that's behaving better than the rest, so that we can make sure our portfolios stay in tune. If there's nothing working or big parts of the market are failing, we're very happy to step aside and reduce our exposure and hold a cash weight if that's necessary. What we're selling is a tactical approach. We think that people have an expectation, one, that will get them into the way of good ideas, but second, that we'll do everything we can to step aside when things are more dangerous. So we use these tools to try and do that. We think 70% of return comes from getting to the right neighborhood, being in the right asset classes or sectors or themes. And then within those, identifying specific securities that allow us to take advantage of those themes. So we do our top-down work, which is aimed at finding areas in our investable universe that are seeing a tailwind, where we're seeing in what we look for is expanding breadth. And then we do our bottom-up work to look at the broad universe of individual securities to try to identify those that are good getting better, where we see fundamental characteristics improving and see price characteristics or technicals that would support that view. If we think something looks wonderful fundamentally, but technically it's broken or unattractive, we're going to assume perhaps there's something we don't know. And so we need to see both of those pieces fit together. The top-down work is, of course, focused on breadth. So when a group turns up after being under or out of favor, We look for the first few securities that start to strengthen early, that are fundamentally attractive. We'll only buy a sector while we're seeing expanding breadth or more and more stocks participating in a rally. That's a healthy market. There's no bear market in history ever took place while the percent of securities underlying that were performing well was expanding. That's a healthy market. Now, often late in advance, when there are risks, while everyone's focused on the leaders, some of the weaker securities will start to sell off, and it may not impact an index. They may be held in by the largest stocks. But if enough stocks break down, eventually the selling will get to the generals. So we want to know when breadth starts to deteriorate, because it tells us don't put any new money to work in this group, because the trap door may open under one of the stronger stocks next. So when breadth is contracting, we tighten up the stop losses that we hold on individual positions. We stop putting any new money to work. If we get stopped out, we look at other parts of the market to focus on. So a week ago, we highlighted that the percent of stocks in uptrends and the NYSE had been backing off for the previous couple of weeks. And some of our short-term indicators of breadth, the percent of stocks trading above the 50-day moving average, had been weakening. It had actually come down from 86% over the last few weeks to about 30%. So only 30% of stocks as of last week were trading above their 50-day moving average. The percent of stock with upward trajectory or weekly momentum had come down to about 40%, again from over 80%. Percent of stocks making new highs versus new lows had been contracting. Percent of stocks trading above the 150-week moving average or longer term moving average also was showing some contraction. We showed that the breadth for global markets had maintained a positive bias, and Canada, acting actually a lot like global stocks, also had maintained a positive bias. So here we are a week later. What's changed? Well, one thing, percent of stocks trading above the 50-day moving average in the US actually ticked higher by about 10% in a week where we saw some sloppiness in US stocks. Breadth didn't get any better in the US, but didn't get any worse. Breadth in Canada and globally stayed pretty firm. And we've seen some small improvement in the percent of stocks above the 150-day moving average, not enough to reverse this indicator. The percent of stocks trading above the 50-day globally likely reversed today, we'll note tomorrow. So some small improvement, but it means we're still sort of sitting on our hands. We got to make sure we're being critical of the positions that we have. If positions break down technically, they got to be gone. And if we build a little cash, that's fine. Now, as it turns out, we got stopped out of a few positions, but really not anything substantial. But we'll talk about that a little bit later. Okay, so just quickly, let's talk leadership for a minute. Last week, we highlighted that financials had pulled back a little bit when we looked at a point and figure price chart. A small pullback relative to the recent rally. Not enough to give a sell signal. There's no double bottom. There's no breakdown, no lower high. So what happened? Interesting. This is the XLF, the broad-based financials ETF. One of the reasons that we're big holders is we've seen expanding breadth and relative strength versus the S&P has been rising steadily since June of 2022. Actually, that's important because it was improving for months before we saw the market low in October. This has been a relatively outperforming group. Now, they are lenders, not borrowers. These companies generally benefit when there's a little more inflation, the insurance companies and the banks, but they've been outperforming. The past week, while there was a little bit of sloppiness, 1, 2, 3, 4, 5 up days, a sharp move higher in relative strength. And in fact, we made relative strength new highs versus the market 3 different days. So long-term bull market is certainly intact. Tiny little pullback over the course of the month. We've already gained back half of what was given up. When we look at the banks, ETF, KBE, which is the large banks, rising relative strength, sharp move higher last week. We highlighted that JP Morgan had pulled back a little off the earnings, but again, had been pulling back to higher lows over the last number of months. That's very constructive. This week, straight back to a relative strength new high. And something else I noticed this week, and we talked a little bit about internally, Goldman Sachs. Now, if there was a canary in a coal mine that you were watching for signs of weak financial markets, it would be unlikely that Goldman Sachs would make a new high relatively versus the market and absolutely in price on the first sign of strength. So I think that this is really interesting. It's something that is worth watching. Of course, Goldman Sachs, big beneficiary of increased deal making, increased IPOs, and increased trading volumes. So something to watch. Moving on, industrials. There's the industrials ETF, equally weighted, VIS. It's been moving sharply higher since the October low. In fact, it moved up about 37% off the lows, pulled back a little bit over the last couple of weeks, a little higher this week. I've asked James Callahan to come on. One of our key companies reported last night, Crane. This was a position we put on over the last number of months. James, tell us a little bit about this company and how did it go?
Yeah, thanks, Dave. I'm happy to. So Crane Company, it's a small cap name, so we don't own it everywhere, but we do have a decent position. So they manufacture specialty pumps and valves, and it's one of the cleanest stories you can find in public markets, definitely clean for the industrial space. So the story on it is it was spun out of a larger organization last year. As I said, the business makes specialty pumps and valves for applications like aircraft hydraulic systems, utilities, HVAC for the medical industry as well. All they want to do is make pumps and valves, and they want to grow by acquiring other pump and valve manufacturers and then eventually sell to a larger diversified industrial company. And they plan to pay some dividends and buy back shares along the way, which is great. So as you said, Crane reported earnings yesterday after the close. They delivered a great quarter, great numbers. But also, probably more importantly, they exhibited some evidence that management is continuing to execute on their plan. So they beat nicely on revenue and EPS. All segments were strong. They raised full year EPS guidance by double the beat over this quarter's expectations, which was nice. And then they announced an acquisition for their process flow technology segment. So they're going to buy a small company that makes specialty pumps and valves for $68 million in cash. So the stock's being rewarded today. It closed up about 5%. It's a good industrial story that we continue to like. We've owned it for a number of months now, as you said.
It's interesting, James, isn't it? Very often when companies get spun out, the first few months, people who wind up getting shares because they were shareholder in the previous company don't really know what it is. It's often a small holding. They decide to boot it out because they don't understand it necessarily. Generally, we find that they set these companies up well to succeed once they do get spun out as independent companies. But there's lots of opportunity for them to execute and come through. So as a company starts to report its clean numbers, oftentimes they start to get revalued, and this is something I know, James, you brought to our attention, and it's fitting in really well with the portfolio. So thanks so much for that.
Yeah, my pleasure, Dave. And if I can add one more thing, I think investors need time to get comfortable with a new company that trades independently, the SpinCo. And it's good we're seeing evidence that management is actually executing on the things that they've told investors they plan to. So it's great. They're getting more analyst coverage as they continue to trade, and it's a good story from start to finish, very clean.
Yeah, well, it's interesting. Relative strength has been rising steadily since April of 2023, and certainly making new relative strength new highs today. So thanks so much for that.
Thank you.
Good getting better. These are the types of things that we want to focus on. Moving on, basic materials pulled back a little bit over the course of this past week. The copper companies in general, strong, pulled back a little bit today. Freeport, which is one of our holdings, beat both in earnings and revenues yesterday. There's going to be a bunch more basic materials companies report over the next little bit, so we'll follow on there. Cameco continuing to perform well. In energy, energy has remained near the highs. This is the XEG, which is the Canadian energy producers ETF. I think that Amit Joshi is going to come in and talk about a couple of our names next week when we got a little bit more time. But on a relative basis, this group is held in really well. And interesting, I thought this was a great chart. This is Prime Book holdings. So prime brokers tend to hold holdings for asset managers, fund managers, and they're just showing how the holdings of energy companies has steadily been falling in their long short holdings while the price of energy has been higher. So at some point, people start to feel pain. Now, energy at the worst point was only about 2% and change of the S&P. It's now closer to 4%. But this has been as high as 15% in the past. So as it becomes a bigger part of the index, it becomes more important to investors. And as you can see, investors not heavily weighted in the US, certainly. Technology over the course of the week was a little bit weaker, as I think most people know, that we've talked over the last few weeks about relative strength waning a little bit through the course of 2023. Nothing serious, just not the same kind of outperformance that we've seen. Last week, they got to a few of the leaders. NVIDIA was down a bunch on Friday, had a good day today and a good day yesterday, and not broken down technically, but certainly, shook a few people. After it's up as much as it's been in the last year, you could expect it to pull back a little bit. But we did get stopped on a couple of positions. It took our energy weight down by about 2.5%. We'll touch on that later. We talked a little bit about utilities. Now, utilities have underperformed for a couple of years, and that makes sense as rates have been going higher, longer duration assets, companies that you have very little growth rate in and a high dividend have tended to underperform. But over the last few weeks, we've seen an improvement in relative strength. Now, I'm often asked if, because we buy high relative strength companies, if we're momentum investors. And I suppose you could say that, when a sector gets into gear, we hope to get invested and hope to understand why it's being revalued, find the leading companies, and then stay in them as long as they work. But part of our strategy is a little bit different than that, in that we look for groups or sectors where breadth has become very narrow, where almost nothing is working, and watch for the beginning of breadth expansion, or when some of the leading stocks start to do a little bit better, and start with partial positions in the best company that we can find, where we're seeing improving fundamental characteristics and improving technical characteristics. So, right, we have to recognize change. And so internally, we've been talking about this a little bit. I asked Jim Skatakis to come on today. We've owned this company, NextEra Energy, in the past. It's been very, very good. And maybe Jim could talk a little bit about why we're considering it in the portfolios. It's a sector we've been out of for some time. Jim, what are your thoughts?
Thanks, Dave. NextEra is sort of one of the leading utilities in the United States, concentrated in Florida. And it's really two companies. It's a regulated, 2/3 a regulated Florida-based utility. And then 1/3 is a massive renewables business. And what we've seen is that they're starting to grow earnings significantly. And Dave, do you have those a couple of charts? There we go. So firstly, we're 2/3 of their business is in Florida. And when you look at customer growth, the chart on the right, that's been going up as many people have been moving to Florida during the pandemic and beyond. On the bottom, Florida, on bottom left, Florida unemployment and is at all-time lows. And on the bottom right, Florida GDP, it just continues to accelerate upwards. And then in the top left, we can see that they had a headwind in terms of weather. So weather, you have to normalize revenue because of weather. It's not, it's really hot, then they get massive load demand. If it's temperate, they don't. And so weather was a 5.5% headwind, but they managed to outgrow that and give us while sales were only up, were down 1.3%. Earnings were up over 13%. So
So
we're
Jim, that's an
seeing,
interesting thing because, one of the knocks against the renewable companies and sort of broadly across the board is that it's been very hard to make money in wind and solar. And as a long duration asset, hard for the market to want to pay for it in a world of rising rates. What has made a NextEra successful in this area?
well, they were in the market in renewables early on. Over the last 10 years, they've scouted the best wind locations and tied them up so that they can put wind farms on at the appropriate times when they have long-term contracts for the power. So they're a very forward thinking company. They uh, they used AI in building out their renewables business. So they have over 12 gigawatts of renewables that they manage, and their control room is 8 people. Just for context, the Ontario electricity market is roughly 25 gigawatts. So with 8 people, they're able to manage all of that through automation, and they're able to look at the what's going to fail. Is there something in the is something overheating? Is something vibrating? Is there a buildup of sand? Are the blades on a turbine vibrating? Are the bearings heating up? Is the lubricant viscosity low? So they have all these metrics, and the AI points them in the right direction, routes power around the problem, dispatches crews to fix the problem, and move on. So it's the leader by far in this area. And an analyst once asked whether they would offer this as a service to other utilities, and they balked. They said, "No way! This is part of our secret sauce. We're not sharing this at any price." So
Right.
smart company, and
It helps to understand that stuff, and we've talked about utilities as being in general high dividend payers with very little growth. It's amazing. I was looking this morning. NextEra's 5-year dividend growth is 11% a year. I mean, so this is a dividend grower. It is a growing company. It's a company that has something special, and it's why likely it is outperforming its peers and the sector, and one that we likely will look to add. So I really appreciate Jim you jumping on today. It's you've spent a lot of time on this one, and you certainly know it cold.
I just wanted to point out one more thing, Dave,
Yeah,
for because especially for everyone in Ontario, look at the bottom point on this. They've reduced the average electricity bill is below 37% below the national average in the US. So, and um, the their average residential bill is below what it was 10 years ago. I'm not sure I can say the same for my electricity bill. So that's the secret of their success.
Yeah, no, it's really, really pretty impressive. Thanks, Jim. Looking outside of the utilities and in sort of some of the other defensive sectors, healthcare slightly better over the week, but still relative strength is waning. Telecom relative strength continues to be weak. REITs relative strength basically at lows, and high multiple tech also still sort of struggling with the higher yields in the market. So plenty of haves, plenty of have-nots. It's interesting. When the market pulls back, it doesn't mean everything pulls back the same way. And of course, we're hoping to be in those resilient groups that do have improving breadth. That tends to be a shock absorber a little bit better. A couple of other key focuses, gold versus utilities probably points still to reflation versus disinflation. And when we take that all back to the portfolio, financials continue to be our biggest weight. Slightly down from where they were at the peak. They're at 23% of our overall firm assets. S&P weighting is about 12%. So that's a significant overweight, just about a double. Industrials continue to be a very significant overweight for us. Good pricing power here, as we saw in the case of Crane. Technology has come down a little bit further. A month ago, it was at 14%, about half the weight of the S&P, partly because we had seen some deterioration in breadth, partly because we had seen some weakness in the group. It's a little lower again this week, 11.8%. Energy maintains a very significant overweight. Materials are very significant overweight. And when we get to defensive groups, you can see still quite low. One group I will mention that has been continuing to weaken is consumer discretionary. They're probably the biggest group impacted by rates. 10% of the S&P were just about 2% weight in the portfolio. So I think things continue to be pretty well aligned. We're watching credit spreads to see if they start to widen. They seem to be pretty benign. If you look at the high yield bond ETF JNK relative to the investment grade ETF, this is supposed to be a higher risk part of the bond market. It means that investors are paying for economic strength, not weakness. Volatility spiked briefly over the course of the week, but very quickly came back into the range that you tend to be in during cyclical bull markets. So it doesn't look as though this has lasted a long time. We'll see. And of course, we're now into earnings and we're watching them closely. Consensus is for 3% earnings growth year over year for the S&P 500. This is supposed to be the weakest quarter of the year. Q2, Q3, and Q4 are expected to show nice earnings growth. Goldman Sachs believes that we're going to see much better than that for fiscal 2024. They're expecting 9% earnings growth, fiscal 24, and 13% in 25. We're just a little ways into the earnings period so far. Earnings growth coming in at about 9%. So we'll see. We're only very early on in the reporting period. We're watching that. And we're also watching how stocks are reacting to the news. In general, reactions have been pretty favorable to the earnings news. So I'll finish with this crazy table of stats. If we go back and look at markets after a 5-month winning streak, what happened going forward? 6 months out, the market was up an average of 9%. 27 occasions it was higher, only 3%. 3 occasions it was lower. So that's a little over 90%. If you look a year out, on average, the market was up about 10%, 24 up, 6 down. If we look just at the quarter, 25 up, 5 down. So we think that in general, things look very positive. We'll wait and see some of our short-term indicators flip back higher before we add back any of the small amount of cash that we wound up with last week. Our positions are holding in really, really well. We're happy with returns sort of so far year to date and over the last year, but we'll continue to monitor. We think that likely, in between these cyclical bear markets, you tend to get 2 and 3 year run-ups in price. So we'll see. It may be that we just seen sort of one of the typical 5% pullbacks the next few weeks. Will tell us a better story. If things get more difficult, we'll get more defensive. But right now, we think that our holdings look pretty darn good. Pamela, if there's any questions, certainly we can take a crack at answering them.
Hey, Dave, thanks so much. And thanks, Jim and James, for joining the program. I know our viewers really appreciated your insight. Dave, this question comes from John. He says, David, you mentioned that you were stopped out, but never said the holdings that were stopped out. Can you advise? So perhaps we can cover that one offline, but
No. I can cover it. We got stopped out of Shopify. We got stopped out of Arista Networks, which was a relatively small position. We got stopped out. We did not get stopped in NVIDIA.
CrowdStrike and ServiceNow.
CrowdStrike and ServiceNow.
They were all pretty small positions, but
yeah. So in the scheme of things, nothing that was a top 10 position. But Jim, it was really only represented like sort of 2.5% of assets. Is that about right? That's what it looked like to me in the numbers.
Probably less.
Yeah. So nothing really significant, but we want people to know we follow our cooking, and we get stopped. So we'll see how this week goes. It may well be we got stopped out at the lows, but our first job is to make sure that a little mistake doesn't turn into a big one, and that we protect gains. And in many cases, in this case, we were protecting gains. So, any other questions?
Yes, Dave, we just received a question from George. He wants to know what your view is on FCX, if it's available, the information. Otherwise, again, we can take this one offline too.
Yeah. So Jim, you're on. Do you want to talk? I know you were looking at the earnings last night. James talked about them this morning. Let's just see if I can throw up. Here's the longer term picture of FCX. Fits very well with the copper chart. I know that they beat on earnings and revenue. Started weak, strengthened through the day. Do you have any thoughts here, Jim?
Well, really, all we've seen is that it's had a very nice move over the last few months with copper prices, and it's not unusual for it to pull back. There was nothing that we saw in the earnings or in the operating metrics that made us worry. So, from a fundamental point of view, there's nothing of concern. We're just watching copper prices and the price action.
Yeah, I mean they did beat both on earnings and revenue. So ultimately, and I'll just pull this up also, just so from a technical perspective. Mm-hmm. Here's the point and figure chart for Freeport. So made a nice reversal in November, rallied through December, pulled back into February to a higher low, made a higher high at $52 and has pulled back, about a third of this column. So nothing negative whatsoever. In fact, the technical target on the point figure chart off the count looks like it's sort of mid 60s. So there's lots of room to go here.
Thanks so much. Stephen from Toronto has a question, Dave. Stephen, you are one of our most valued viewers, just so you know that. Stephen asks, or makes a comment. He says, David, it seems to me that you have outperformed through this weakness. Would you say that is correct? And if so, that's a great validation as an investor.
Well, that's nice to say that, Stephen. So look at there are we're in an interesting market. First of all, correlations stock to stock in the S&P are very low. So that means the market isn't moving like a herd of cattle, right? Or a herd of sheep. It's things are moving independently. So in any market, there's good and there's bad. But when everything starts to move together, it tells you there's a bigger macro issue, and we're just not seeing that. There are sectors that have very clear leadership and are behaving really well, and frankly, are really important to financial markets, like the financial sector, right? That's great news that it's making relative highs. If it was utilities and staples and telecom making relative new highs, that would be a vote by many investors saying, well, we don't like the economy very much. So financials behaving well, industrials behaving well, materials behaving well, energy behaving well. Those are our four big sectors. And so nice to see today, like I'm looking at my screen now, just a sea of green on the day. And so strong stocks should rally when the market bounces, and the strong themes have bounced. I think that we're positioned pretty well. Utilities did hang in pretty well last week. There's certainly some thoughts going around that a proliferation of AI compute centers are going to demand a lot of electricity, maybe create some growth. We'll see. Nextera would be our way of playing that. So yeah, we're happy with the way things are structured.
Thanks, Dave. We have two more questions. Ted wants to know, Dave or Jim, is there an S&P 500 index ETF traded in Canadian dollars that you would recommend at this point in the market?
Well, let me say this. There is, and I'm sorry because I focus on the U.S. names, but I'm going to share a chart that I shared on Twitter today. Don't hesitate to go and follow us on Twitter at Barometer CA, and I'll show you why. Let's make it all, and we're going to do this. So this is a chart that compares the equal weight S&P versus the market cap weighted S&P. And you can see that, you go through periods where the equal weight outperforms and periods where the market cap weighted index outperforms. So as we know, there's 7 stocks that make up a very big piece of the index. And from May of 2020 through until February of 23, the equally weight actually was outperforming the market cap weighted, but very sharp outperformance of the big cap stocks through the last year until the most recent number of months, where it seems to be shifting. So I think it's very possible we're shifting to a market where the equally weighted S&P does better than market cap weighted, meaning the average stock does a little bit better. So I'm not sure I would rush out to buy the SPY or the equivalent in Canada, because you will have an inordinate amount of those big stocks after a period where they've really outperformed. So we'll see. I put up the chart a few weeks ago, and I just want to see if I've got it here. Yeah, I do. So let's see if I can put it on the screen. Of the last 65 years, the market cap S&P beat the equal weight only 25 out of 65 years. Now, last year, 100% for sure, it way outperformed. The relative return for the cap weighted versus equal weight, on average, underperformed. And in periods where it did underperform, it can underperform by a bunch. So I'm not sure I would race out to buy the S&P 500 ETF. I think that the Russell is starting to look a little bit more interesting. The equally weighted S&P would be one worth looking for. Or you can hire a stock picker or someone's a little bit more tactical, because we're in a market where there is a great opportunity to outperform as we're seeing right now.
Thanks, Dave. And so the final question, I think you've clearly answered it. Should people be deploying capital into this market right now?
Look, so we are invested. When I say that when breadth models are contracting, we're not adding a lot, it's because we want to have, some flexibility. If you're sitting on a lot of capital right now, the forward-looking data suggests that we have 2 to 3 years in front of us of pretty good markets. We've been through a tightening cycle where already some of the data that was negative for 16 or 17 months has turned positive, like the manufacturing data and the leading economic indicators. That means that maybe things will accelerate even without rate cuts. So yeah, I think that there's opportunity, and I do think that there's limited sort of downside right now. And I think there's different kinds of risks. One kind of risk for investors is that the prices go down. The other kind of risk is, and I've said this a few times the last few weeks, is inflation eats your money. And I think it's clear that inflation is stickier right now than it has been in a while. So sitting on cash, I don't think is a great solution when you've got elevated inflation rate, and some important sectors in the market look very attractive.
Thank you so much. Well, that concludes the questions we've received this afternoon. Dave, as always, I'll leave you with the final word, and thanks again, Jim. Pleasure to see you.
Well, it's great to have Jim and James on. We're going to try and do that more often. Pamela, thanks very much for moderating. And I know next week we're going to spend a little bit of time talking about energy, because there's some interesting stuff going on there, and we got something else lined up too. I can't remember exactly what, but anyway, hopefully it'll be an interesting week and lots of stuff to talk about. If you've got questions in between, don't hesitate to reach out. We love getting your questions. If you're too shy to ask them on the call, send an email, make a phone call. I'm happy to jump on the line and chat with you. And if I can't answer your question, I'll find someone who can. So thanks very much, and we'll see you next week.